Welcome. I'm Adam Jones, Senior Advisor at Keeler Thomas Management, where today we'll be delving deep into the topic of inflation and your retirement. This subject is crucial for anyone planning for those golden years, so let's get started. Inflation, the steady rise in the general price level of goods and services over time, is a phenomenon as old as organized economies themselves. Its history can be traced back to ancient civilizations, with records of inflationary periods in societies like ancient Rome, China, and Egypt. However, the modern understanding and measurement of inflation have evolved significantly. One of the earliest documented cases of inflation occurred during the Roman Empire. Emperors, in an attempt to fund their ambitious projects and military conquests, resorted to debasing their currency by reducing the precious metal content in coins. This led to a gradual increase in prices, effectively eroding the wealth of citizens. Fast forward to the 20th century, and inflation took on new dimensions. The aftermath of World War I saw hyperinflation in Germany, where people needed wheelbarrows of currency just to buy basic goods. The Great Depression of the 1930s brought deflation, a period of falling prices as economic activity ground to a halt. After World War II, many nations adopted the Bretton Woods system, tying their currencies to the US dollar, which was in turn backed by gold. This brought relative stability to the global monetary system. However, in the early 1970s, the US abandoned the gold standard, ushering in the era of fiat currencies. Since then, central banks have used various tools to control inflation, often targeting a specific inflation rate to maintain economic stability. In recent decades, inflation has remained a persistent concern for central banks and individuals alike. Understanding this historical context is crucial for comprehending the challenges and strategies related to inflation in today's complex global economy. So, what exactly is inflation? Well, simply put, inflation is the increase in the general price level of goods and services over time. It means your money's purchasing power diminishes as prices go up. Imagine buying your favorite groceries today and then realizing you need to spend more for the same items in the future. We all feel that one, don't we? Inflation, often referred to as the silent thief, stealthily erodes the purchasing power of money over time. This insidious economic phenomenon might not grab headlines like financial crises or stock market crashes, but it's a gradual impact that can be just as devastating, if not more so, for everyday citizens. Imagine you tuck away $1,000 in a savings account with a 2% interest rate. On the surface, it seems like a smart move. However, if inflation is running at 3%, your money's real value is actually decreasing. In a year, your $1,000 might grow to $1,020, but due to the rising cost of goods and services, that $1,020 will buy you less than the initial $1,000 did. Over time, this silent theft compounds, affecting your retirement savings, purchasing power, and your quality of life. Smart investors and central banks must continually monitor and adapt to the subtle erosion caused by inflation to protect wealth and economic stability. Inflation is a formidable adversary to anyone planning for retirement. While it may not appear as an immediate threat, its long-term impact can be detrimental to your financial security in retirement. Picture this: you've diligently saved for your golden years, only to realize that your pile of hard-earned cash isn't quite as impressive as you thought. Why? Because inflation has been nibbling away at it year after year like a persistent but unnoticed pest. Inflation's superpower lies in its ability to erode your purchasing power. That means the dollars you've salted away in your retirement accounts may not stretch as far as you've hoped when the time comes. What used to be a comfortable lifestyle can suddenly feel like treading financial water. And it doesn't stop there. Inflation can sneak into your investment portfolio as well, especially if you're playing it safe with low risk, low return options like bonds. If your investments aren't growing at a pace that outsmarts inflation, you could find your retirement fund failing short of your expectations. What about compounding interest, the magician of the financial world? It has the power to turn modest investments into substantial wealth over time. It's like a snowball rolling down a financial hill, gaining momentum and size as it goes. Here's how it works. Let's say you invest a sum of money and it earns interest. In the first year, you earn interest not only on your initial investment, but also on the interest it generated. In the second year, you earn interest on your original investment and the interest from the first year. This snowball effect continues, and with each passing year, your earnings grow exponentially. Over time, this compounding effect can significantly boost your investment returns. It's the secret sauce behind many successful retirement portfolios. By reinvesting your earnings, you harness the power of time and patience, allowing your money to work for you. The earlier you start, the more impressive the results. Compounding loves time, so make it your financial ally. Whether you're saving for retirement or other financial goals, embrace the magic of this compounding interest and watch your investments flourish like a well-tended garden. Planning for retirement isn't a sprint, it's a marathon. It's not just about stashing away funds for the short term, it's about creating a financial fortress that will withstand the test of time. A key adversary in this financial marathon, though, is this inflation. Over the long haul, inflation can act as a silent, relentless thief, stealthily stealing the value of your hard-earned money. To combat this financial villain effectively, you need a strategic financial plan that considers the marathon ahead. It means thinking beyond the finish line and making informed decisions to safeguard your savings against the corrosive effects of inflation. Diversifying your investments, incorporating inflation-adjusted instruments, and periodically reassessing your retirement plan are essential steps in this journey. In this marathon, you're not just aiming to accumulate wealth, you're aiming to preserve and grow it. Your financial plan should be designed for the long run, anticipating the hurdles that inflation throws your way. By embracing the mindset of a marathoner and crafting a resilient financial strategy, you're setting yourself up for a retirement that isn't just secure, but thrives in the face of inflation's relentless march. Diversifying your investments is like building a financial shield against the silent thief of inflation. Inflation steadily erodes your purchasing power of your money, making each dollar worth less over time. But a well-diversified investment portfolio can help you stay one step ahead. When you diversify, you spread your investments across various asset classes such as stocks, bonds, real estate, and commodities. Each of these assets has a unique response to inflation. Stocks, for instance, often rise with inflation because companies can increase prices and revenues. Bonds, on the other hand, might lose value due to their fixed interest rates, but they do have their place. Real estate and commodities, like gold, tend to act as hedges against inflation. By having a mix of these assets in your portfolio, you reduce the risk of inflation gnawing away at your savings. When one asset class struggles, another might thrive, helping you maintain your purchasing power. Diversification is your financial armor, defending your wealth against the insidious effects of inflation and providing you with greater financial security in retirement. Inflation has the potential to impact your daily expenses significantly. It's like a slow leak in your financial boat. If left unchecked, it could lead to your sinking of your financial ship. To navigate these treacherous waters successfully, you need to consider adjustments to your budget and your spending habits. Finding the right balance is key. While it's important to savor life's pleasures and enjoy the present, it's equally vital to secure your future. So, it's time to become a savvy captain of your financial ship. Start by identifying areas in your budget that can be trimmed or optimized without compromising your quality of life. Cut down on discretionary spending, hunt for deals, and consider more cost-effective alternatives. Redirect some of those funds towards investments that have the potential to outpace inflation. By proactively managing the impact of inflation on your daily expenses, you're not just preserving your financial stability, but charting a course toward a more secure future. It's all about striking the delicate balance between enjoying today's sunset and ensuring you have smooth sailing into tomorrow. Bonds, often viewed as the steady ship in the stormy seas of financial markets, can indeed be a valuable tool in your retirement arsenal. These fixed income securities are like your trusty lifeboat, providing a reliable income stream when you need it most. One of the key advantages of bonds, especially for retirees, is their ability to act as a cushion against the erosive effects of inflation. While inflation can erode the purchasing power of your savings and investments, bonds can help you keep your financial ship afloat. Many bonds offer regular interest payments that can supplement your retirement income. This predictable income stream can be especially reassuring when other investments might experience turbulence. However, it's important to choose your bonds wisely, considering factors like the maturity date and the issuer's creditworthiness. Diversifying your bond portfolio can also enhance its effectiveness as an inflation hedge. So, think of bonds as your reliable crew members, helping you navigate the challenging waters of retirement with financial security and peace of mind. Social Security, often considered the safety net of retirement, plays a vital role in the financial security of many retirees. Yet its effectiveness can be influenced by a silent financial assassin. You guessed it, inflation. To safeguard your retirement income, it's crucial to keep a close eye on the cost of living adjustments, or COLAs, made to Social Security benefits. COLAs are designed to help keep your benefits in pace with ever-rising costs of living. They serve as a financial shield, preventing the erosion of your purchasing power over time. Your diligence in monitoring COLAs can make a significant difference in your retirement planning. These adjustments are typically based on the Consumer Price Index, or the CPI, reflecting changes in prices for various goods and services. By staying informed and factoring these adjustments into your financial strategy, you can better ensure that your Social Security benefits remain a reliable source of income, helping you maintain your financial stability in retirement. In the labyrinth of retirement planning, especially when dealing with the formidable foe of inflation, seeking professional guidance can be your best strategic move. A skilled financial advisor is your navigator, guiding you through the twists and turns of financial markets, investment options, and inflation-fighting tactics. Their experience can help you craft a personalized strategy tailored to your financial goals and your risk tolerance. They can introduce you to diversified investment portfolios, inflation-protected securities, and other financial instruments designed to withstand the erosive forces of inflation. Moreover, they can assist you in reassessing your retirement plan periodically to ensure it adapts to changing economic conditions. With their support, you can confidently steer your retirement ship towards calmer financial waters. While it might seem like an additional expense, the potential gains in investment returns, inflation protection, and peace of mind make it a wise investment. So, when it comes to securing your retirement amidst the inflation storm, remember that the right financial advisor can be your true north, guiding you safely to your retirement goals. In conclusion, understanding how inflation affects your retirement is vital for securing your financial future. By being aware of inflation's impact and implementing smart strategies, you can better prepare yourself for a comfortable retirement. Thanks for joining us today. If you found this video helpful, don't forget to like, share, and subscribe for more valuable insights. Until next time, take care and plan wisely for your retirement.